Welcome to the Deep Dive. Today we're tackling a really big one, something many of you have asked about, the shifting global economic landscape.
Yeah, it's definitely a hot topic.
We're diving straight into a recent, very insightful discussion with Yanis Varoufakis, the economist, former Greek finance minister. It was on Glenn Deason's YouTube channel.
Right. And our goal here for you listening is basically to cut through the noise. We want to pull out the key bits of Varoufakis' analysis.
What's his take on the current economic order, U.S. aims, Europe's challenges?
Exactly. Think of this as, well, a shortcut to understanding these really complex global dynamics that are playing out right now.
Absolutely, because you hear about trade wars, inflation, all these geopolitical shifts,
Yeah.
and you wonder,
Is the old order really ending?
yeah, is it? Like Varoufakis seems to suggest. Okay, so let's get into it. He starts way back looking at the long-term goals of the U.S. economy.
And what's really interesting, kind of right off the bat, is his argument that the core U.S. aim hasn't really changed much since World War II.
Which is?
To be a sort of global Germany, strong manufacturing, net exports. That's been the underlying goal, he says.
Okay, so how did Bretton Woods fit into that? You mentioned that system.
Right. Bretton Woods, it wasn't just about exchange rates. The key part for this argument is that the U.S. was running massive trade surpluses back then.
Okay.
But here's the clever bit, the strategic part. The U.S. recycled those surpluses, pumped them back into Europe and Japan. Think Marshall Plan, loans.
So not just aid, but a way to make sure they could buy U.S. goods.
Precisely. It was about creating or maybe ensuring demand for American exports, a way to keep the U.S. economy humming after the war. Kind of a design system, though, ultimately not sustainable.
Built on those surpluses, basically.
Yeah, exactly. And Varoufakis points out the second the U.S. stopped having those surpluses, the whole system started to wobble.
Which brings us to Nixon. He draws a parallel there between Nixon and Trump.
He does. When the U.S. couldn't sustain the surpluses anymore, Nixon, back in '71, essentially killed the Bretton Woods system. Varoufakis uses this as a kind of historical echo for what Trump tried to do, disrupting the current setup.
Got it. So that original recycling mechanism, U.S. surpluses funding others, breaks down what replaced it. He calls it an inverted system.
Yeah, inverted. It completely flipped. After Nixon, American deficits became the big driver of global demand. So countries like Germany, Japan, and then crucially China, they built their export machines selling stuff to the U.S. market.
And all the dollars they earned selling goods to Americans, where did they go?
They flowed back, right back into the U.S., but this time mainly through Wall Street. This huge wave of capital-financed U.S. government debt, it fueled the stock market, pumped up real estate, and Varoufakis is clear. This system almost demanded Wall Street deregulation to even function, to handle that massive flow.
Okay, this is where it gets really interesting, I think. He talks about cloud capital. What's that?
So, cloud capital. Varoufakis uses this term for the huge concentration of wealth and, maybe more importantly, power in big tech.
Like Google, Amazon.
Exactly. He argues that things like quantitative easing after 2008, plus the fact that nobody was really investing in old-school industry in the U.S. or Europe, all that money disproportionately flowed to big tech.
Right.
They built up this enormous capital base, often without making physical things, and gained the power to extract rents, basically, taking value from other parts of the economy.
So while Wall Street and big tech were booming, what about the average worker in the U.S.?
He ties it directly together. This inverted system, the rise of cloud capital, it went hand in hand with U.S. deindustrialization. Manufacturing goes overseas.
And the working class, especially in places like the Rust Belt.
Exactly. They felt the pain, lost jobs, stagnant wages. And Varoufakis argues that's the discontent, the economic anxiety that someone like Trump tapped into with Make America Great Again.
But he also says, look, Trump starting this doesn't mean he finished it. It's not automatic. Like Nixon's move wasn't instantly permanent either.
Good point. Yeah, Nixon pulled the plug on Bretton Woods, but it took policies from later presidents to really cement that new reality. Varoufakis sees a similar dynamic now. Trump might have initiated a shift, but it needs sustained policy over time to stick. It's not a done deal.
Okay, let's pivot to Europe. You said our listener was really interested in Europe's response. I mean, they're losing that easy access to the U.S. market, losing cheap Russian gas. Varoufakis isn't exactly optimistic, is he?
No, not at all. His assessment is pretty blunt. He basically says Europe is reacting with panic, and there's no real plan, just reacting.
He even links the Eurozone's creation back to that earlier shock, the Nixon '71 decision. What's that connection?
Well, his argument is that Nixon kicking the dollar standard effectively booted Europe out of that stable currency zone. So creating the Eurozone was partly, at least, Europe trying to build its own stable monetary system in response.
And he describes the early EU, the coal and steel community, in a kind of unusual way, like a business arrangement.
Yeah, it's a fascinating analogy. He compares it to a cartel, like OPEC almost.
Really?
He suggests the initial EU structure was like big industries agreeing to limit competition, keep prices stable, starting with coal and steel, then bringing in farmers with the common agricultural policy was, in his view, a way to spread some of those industrial profits around.
And for any cartel arrangement like that, stable exchange rates are crucial, aren't they?
Absolutely. Wildly fluctuating currencies would just blow the whole thing up. So that's why you saw all those attempts at currency cooperation,
Right.
the snake, the EMS, the ERM. They kept failing, but it showed the need, leading eventually to the euro.
But according to Varoufakis, the euro was built with some major flaws baked in.
Yes, the critical design flaw, he argues, was launching a common currency without a common treasury, without strong democratic federal institutions to manage it all. That imbalance, he says, led directly to the euro crisis we saw.
And the way Europe handled that crisis, austerity plus money printing, that caused its own problem.
Big time. Varoufakis argues austerity just killed demand, while the money printing mainly helped the banks. His go-to example is Volkswagen using cash for share buybacks instead of investing in, say, EVs.
Right.
And that pattern, that lack of productive investment, he says, has dogged Europe for like 15 years. Plus, it created these huge political splits between countries.
So now, facing these new global pressures, Europe is still kind of stuck with that legacy. Lack of unity, lack of clear direction.
That's his point. Yeah, there's no strong central political force making clear decisions for Europe Inc., so to speak. He contrasts Merkel's past influence with today's fragmentation. You see different, sometimes conflicting signals from leaders like Merz or Macron, and the Commission under von der Leyen seems, well, weak in his view.
He mentions a huge number, too, a 600 billion euro annual investment gap in Europe. And he seems really critical of the push for more military spending.
Very critical. He sees it as pouring money down the wrong drain, essentially. It might help defense contractors, sure, but it doesn't fix Europe's core problem, the needed for investment in things that actually grow the economy long term. Productive stuff.
And that lack of investment feeds directly into Europe, falling behind in the Fourth Industrial Revolution. Tech, green energy.
Yeah, and the example he uses is pretty stark. Germany used to lead in solar panels, right? Now China completely dominates.
Wow.
And he insists it's not just about Chinese subsidies, it goes deeper. It's about Europe simply not investing enough in R&D and production for the last couple of decades.
So Europe tries to compensate with regulation, but that doesn't really work against big tech, the cloud capital.
That's his argument. Regulation is kind of a weak weapon when you don't have your own champions, your own tech giants, threatening U.S. big tech with digital taxes. Europe doesn't have the leverage, he thinks. What if the U.S. just says, fine, no Google Maps for you for a week? They could call Europe's bluff.
Which leads to this whole idea of strategic autonomy and how Europe deals with China. He sees a big difference in approaches.
A huge contrast. He points out how Europe seems almost subordinate to the U.S., even when U.S. policy under someone like Trump might not even align with European interests. Meanwhile, China is playing a long game, pursuing its own strategic path, diversifying partners.
China has a plan, Europe doesn't. Is that the gist?
Pretty much. He sees China acting rationally, strategically. Europe, he argues, lacks that coherent macroeconomic plan, that investment strategy. So he actually proposes 3 immediate things Europe should do.
Okay, what are they?
First, he says, basically ignore Trump. Stop trying to appease or get special deals. Instead, open direct talks with Beijing. And crucially, unilaterally drop all EU tariffs on Chinese goods. He specifically mentions those solar panel tariffs that were put in place partly because the U.S. wanted them to be.
Okay, ignore Trump, talk to China, drop tariffs. What's the second thing?
This one's about economic coordination. He proposes a coordinated stimulus program between the European Central Bank, the ECB, and the People's Bank of China.
Why?
To fight off the recessionary forces he sees coming from all these trade disruptions and geopolitical uncertainty, a joint effort to boost demand.
Interesting. And the third, immediate action.
Industrial collaboration. He suggests actively looking for joint ventures. He points to past examples where European know-how helped China build railways and suggests doing something similar now, maybe with EVs like VW and BYD working together in Germany.
Okay, those are the immediate steps. But he also has a bigger, longer-term investment plan for Europe, right?
Yeah.
Sounds ambitious.
It is ambitious. He talks about a pan-European initiative, something that funds profitable projects directly across the continent. Think Marshall Plan style, not channeled through national governments or flawed setups like the Pandemic Recovery Fund.
And how to be funded.
He suggests using the European Investment Bank, the EIB, to issue bonds. A lot of bonds, like 600 to 700 billion euros worth every year for maybe 5 years.
Wow, that's huge. How do you keep the interest rates down on that much debt?
That's where the ECB comes in again. Varoufakis says the ECB needs to commit upfront to buying these EIB bonds in the secondary market if needed. That commitment would anchor interest rates, keep them really low, making the whole thing affordable. And that money gets funneled into key future technologies.
Okay, and then there's this third big idea, the digital wallet one.
Yeah.
An ECB digital wallet for everyone.
Yeah, this one's quite radical, maybe inspired a bit by China's digital yuan experiments. The idea is the ECB creates a digital wallet app for every European.
What would that actually do for people?
2 main things, he suggests. 1, you could hold money in it and earn the ECB's own overnight interest rate, probably better than your bank gives you. 2, it would allow free, instant digital payments across the Eurozone. No bank fees. It's a direct challenge to the commercial bank's payment monopoly and a way to compete with Chinese systems like Alipay or WeChat Pay.
Okay, so he lays out these potential solutions, talking to China, massive investment, the digital wallet. They sound logical, at least on paper. Why isn't any of this happening? What's the blockage?
He puts it down to a mix of, well, ideology and plain old vested interests. He talks about the power of the big banks, especially in Frankfurt and Paris. They would fight tooth and nail against losing their grip on the payment systems. He says he saw this resistance himself when he proposed similar things as finance minister.
So the banks are one obstacle. Any others?
He also points to something deeper, within Germany mainly, a sort of fundamental discomfort within the German financial and industrial elite about being locked into the Eurozone.
Really? They want an exit option.
He argues they secretly want to keep that possibility open, and that underlying feeling makes them resist things like common Eurozone debt or huge pan-European investment schemes funded by common borrowing. It relates back to that power imbalance you talked about between the surplus countries like Germany and the deficit countries like France or Italy.
Okay, let's try and wrap this up for our listener. If you had to boil down Varoufakis' main points.
Basically, the old economic order, the one dominated by the U.S. after Bretton Woods and then after Nixon, is ending. The U.S. is trying to rebalance, often clumsily. Europe is caught in the middle, lacking a unified plan or strategic vision. But
there are alternative paths.
Yes, he outlines alternatives. More cooperation with China, not less. A massive internal investment drive focused on the future. And rethinking basic infrastructure like payments.
For me, a couple of things really clicked hearing this. Understanding the EU's origins almost as this, like, industrial cartel.
Yeah, that's striking image.
And seeing how the Euro's design itself kind of baked in some of the problems we saw later. And then the reasons why Europe seems stuck now. The banking interests, that German reluctance, it makes a certain kind of sense, even if it's frustrating.
Absolutely. So the question for you, listening to maybe chew on, is this. Is Europe's current path, this sort of reactive, fragmented approach, is it a conscious strategic choice? Or is it just the result of these deep-seated historical issues, these systemic problems Varoufakis highlights? And thinking longer term, what does that mean for the global power balance and maybe even for your own prosperity down the line? Definitely something to think about.
A lot to think about indeed. Thanks for taking the deep dive with us today.